Hello students, welcome to the revision classes of Risk Management and Insurance, Unit 4. Unit 4, we will understand the following below mentioned concepts. We will understand the meaning of life insurance, features of life insurance, growth of actuarial science, life insurance contracts, life insurance documents, and life insurance classification. Meaning of life insurance. Life insurance is a contract between an insurer and a policyholder in which the insurer guarantees payment of a death benefit to named beneficiaries when the insured dies. The insurance company promises a death benefit in exchange for premiums paid by the policyholder. The payment in life insurance is certain and the time of occurrence is not certain. The life insurance contract is the contingent contracts, while the non-life insurance is the contract of indemnity. Due to this reason, the life insurance is called as life assurance. Life insurance is a legally binding contract. For the contract to be enforceable, the life insurance application must be accurately disclose the insured's past and current health conditions and high risk activities. For a life insurance policy to remain in force, the policyholder must pay a single premium upfront or pay regular premiums over the time. When the insured dies, the policy's named beneficiaries will receive the policy's face value or the death benefit. Term life insurance policies expire after a certain number of years. Permanent life insurance policies remain active until the insured dies, stops paying the premiums, or surrenders the policy. Students, we will now try to understand how this life insurance concept works. A life insurance policy has three main components: death benefit, premium, cash value. Death benefit or face value is the amount of money the insurance company guarantees to the beneficiaries identified in the policy when the insured dies. Premiums are the money the policyholder pays for insurance. The insurance must pay the death benefit when the insured dies if the policyholder pays the premium as required, and premiums are determined in part by how likely it is that the insurer will have to pay the policy's death benefit based on the insured's life expectancy. The cash value of permanent life insurance serves two purposes. It is a savings account that the policyholder can use during the life of the insured. The cash accumulates on a tax-deferred basis. Features of life insurance: nature of contract, insurable interest, utmost good faith, warrants, assignment and nominations, proximate cause, premium, and terms of policy. Now, nature of contract. The life insurance contract follows the provision of Indian Contract Act 1872. This contract builds the contractual relationship between the insured and the insurer. Insurable interest, the second feature of life insurance. There is the requirement of insurable interest at the time of insurance contract. There should be insurable interest of the person for insuring the life. The main risk involved in this policy is the death of the insured. Utmost good faith, that is the third feature of life insurance. Utmost good faith, this contract work on the doctrine of disclosing, in which the various types of material facts which shows the important principle which is applied on all types of insurance. There should be no misrepresentation, non-disclosure or fraud in the document, as it will lead to the acceptance of risk. Otherwise the insurance contract is completely null and void. Next, warrants. Warrants both the basis and important features of the life insurance contract. The contract will be null and void if there is any untrue statement in regard to the material or non-material facts and figures. Assignment and nomination. The assignment and nomination are the basic requirement of the life insurance policy. The assignment of insurance policy refers to transferring the rights of the assured in regarding to the policy to the assignee, whereas the nomination, the person whom the amount is paid on the death of the assured by the insurer. The insurer is required to pay the insured amount in life assurance policy as the death of the assured or is reaching a particular age is certain to happen. Premium. The premium refers to the amount to be paid by the insured for the risk of loss suffered by the insurer. The premium is paid in cash and advance payment of the premium is decided by the contract of insurance. The premium is calculated on the average rate of mortality at the time of life insurance. The premium is paid at the time of maturity or the death of the insured. Terms of policy. The nature of the risk insured is given in the insurance policy. The terms and conditions of the insurance has the time period of the insurance. It has the number of years and the balance of the insured life. Growth of actuarial science. The basic requirement of science of life insurance is precise knowledge about the rate at which members of a group will die at a given age and from year to year. Actuarial science applies mathematical and statistical methods to finance and insurance, particularly to the assessment of risk. Actuarial science includes a number of interrelating disciplines, in particular the mathematics of probability and statistics. Actuaries are professionals who analyze the financial impact of risk, particularly looking ahead far into the future. Actuaries use skills in mathematics, economics, finance and statistics to study uncertain future events, especially those of concern to insurance companies, employee benefits such as medical insurance and pension plans, and social welfare programs such as Social Security and Medicare. There are three premium elements in life insurance rate making: mortality, interest, and the net premium. Life insurance riders. Many insurance companies offer policyholder the option to customize their policies to accommodate their needs. Riders are the most common way policyholders may modify their plan. There are many riders, but availability depends on the provider. The policyholder will typically pay an additional premium for each rider or a fee to exercise the rider, though some policies include certain riders in their base premium. Life insurance documents. A document issued by an insurance company that is used to verify the existence of insurance coverage under specific conditions granted to listed individuals. Various documents are as follows: proposal form, policy bond, alterations and endorsements, reminding notice, and other documents. Insurance premium. The premium is the price paid for the risk undertaken by the insurers. It is a consideration that moves from the proposer to the insurer in exchange for their promise to pay the sum assured on the happening of the contingent event. It can be even defined as the selling price of insurance. That is, the compensation paid by the insured party to the insurer in exchange for having the risk covered. Insurance premium calculations. Premium of the insurance policy is decided considering age of the customer, coverage period and duration of the policy. It is calculated by multiplying the rate of the number of exposure units bought. The term premium may be classified into gross premium and net premium. The gross premium is the premium charged by the insurer to be able to meet the expenses of insurance and pay the amount of claims. It depends upon the mortality rate, the assumed interest rate, the expenses, and the bonus loading. The gross premium includes the net premium and loading. Loading refers to the amount added to the net premium to take care of the other expenses, profit margin, and also a margin towards contingencies. Net premium. We will study the second type of insurance premium calculation, that is net premium. Net premium may further be categorized into net single premium, we call it as NSP, and net level premium. Net single premium in general means the present monetary worth of the future death benefit. It is the lump sum premium amount which together with the return or interest earned thereon is precisely adequate to pay the claim amount. Net single premium in whole life policies. A whole life policy continues for the whole of life and promises to pay the sum assured upon the death of the insured to the beneficiary. Methods of loading. Following are the methods of loading. Please understand, students: constant addition loading, percentage addition loading, modified percentage method, constant and percentage addition method. Constant addition loading, we'll understand each loading method. This method presumes that all expenses vary with the amount of the policy and therefore a fixed amount per thousand of sum assured is loaded into the net premium. Percentage addition loading. Percentage addition loading. Under this method, a fixed percentage of net premium is added to the net premium. It assumes that all expenses vary according to the premium amount. Expenses varying with the policy amount, on the other hand, are completely ignored. Modified percentage method. In this case, the loading consists of those expenses which vary with net level premium for the given policies and also expenses that vary with the net level premium of the whole life policy issued at the given age. Constant and percentage addition method. Under this method, the loading includes a fixed amount per thousand of the sum assured along with the fixed percentage of the net premium for the policy. The percentages are based on the past experience. The life insurance products can be classified into the following ways: term insurance, whole life insurance, endowment insurance, money back policy, unit linked insurance plan, as well as annuity. Now we'll understand each type of insurance in a much detailed way. The first one is term insurance. A term insurance policy is one of the oldest form of policy. It is the pure and basic form of insurance. It is a life insurance where the entire premium paid goes towards covering the risk of death during a certain period of time. Here, in this type of insurance, the insurer makes the payment only if the life assured dies within the term of the policy. In the case of a term life insurance contract, The sum assured is payable only in the event of death during the term. In case of survival, the contract comes to an end at the end of the term. Since only death risk is covered, the premium is low and the contract is simple. The premium is paid throughout the term of the policy or till the prior death of the life assured. Now we'll understand some of the advantages of term insurance. A person having low income can provide for meeting family obligations at low cost. Persons who have invested substantially in new ventures by borrowing at heavy interest rates or mortgaging their property can cover the risk of serious loss to the investment through term insurance at low premium. It is useful as supplement to endowment or whole life policies with a view to get higher risk cover. It is useful to those who need extra protection for a short duration. Next we will study the term insurance products. There are various term insurance products. The following schemes are covered under term insurance products. That is 2-year temporary assurance policy, convertible term assurance policy, Anmol Jeevan I is again very popular. Anmol Jeevan I, it is Life Insurance Corporation of India's Anmol Jeevan I is a unique plan of assurance, by far the cheapest policy to buy, cheaper than even a whole life policy to start with. Anmol Jeevan I is a pure term cover, provides only life cover unlike endowment and money back policies which have a built-in saving element too. Then finally, in term insurance product, Amulya Jeevan I. So what we studied just now, the term insurance product, I'll repeat once again: 2-year temporary assurance policy, convertible time assurance policy, Anmol Jeevan I and Amulya Jeevan I. Then we'll go to the second one, that is whole life insurance. As the name only suggests, students, the whole life insurance policies are intended to provide life insurance protection over one's lifetime. It is a long-term insurance plan. The essence of whole life insurance is that it provides the payment of assured amount upon the insured's death regardless of when it occurs. It means that the sum assured is payable only to the beneficiary on the death of the insured. It is an ordinary and a cheaper type of life insurance policy. Under these policies, the payment of the assured sum is a certainty in contrast to the term insurance contract. Only the time of payment of the assured sum is an uncertainty. Whole life policies can be either participating type or non-participating type. Participating type policies are those which are entitled to a share in the distributable surplus of the life insurance company, whereby the cash value of the policy can go up with announcement of bonus or dividend. On the other hand, non-participating policies have the same benefit throughout the life of the policy. Advantages of whole life insurance: it provides economic security to the dependents of assured. It helps to discharge the liabilities after the death. The premium rates are lower in comparison to other policies. The premiums that are guaranteed never to increase. Some of the whole life insurance products are whole life policy limited payment, whole life policy single premium, Jeevan Anand and Jeevan Tarang. Next we will study the endowment insurance. Endowment assurance policies are considered as the best sellers amongst all the policies. As per the provision of such policies, the payment of assured sum is required to be made as under: to the beneficiary if the policyholder dies before the completion of the specified term, or to the policyholder if he survives till the completion of the specified term. In other words, the assured sum is payable either to the policyholder on the date of policy's maturity or on death of the policyholder if it takes place early. An endowment plan is a combination of term insurance and a pure endowment, and as such offers the benefits of both the plans. Advantages of endowment insurance: in addition to the coverage of life, it even provides a better opportunity of saving and investment. It is flexible in nature as its term is considered concerned, which can be selected by the policyholder according to his or her financial planning and future requirements of funds for any purpose. Endowment insurance products, endowment assurance policy, endowment assurance policy limited payment, Jeevan Mitra. That is, Jeevan Mitra is a double cover endowment plan and triple cover endowment plan. Jeevan Anand, new Janaraksha plan, and Jeevan Sati, a joint life plan. Payment of policy amount, that is money back policy. We will go for the next one, that is money back policy. These policies are structured to provide sums required as anticipated expenses for marriage or higher education over a stipulated period of time. A portion of the sum assured is payable at regular intervals. On survival, the remainder of the sum assured is payable. In case of death, the full sum assured is payable to the insured. Under money back policies, premiums can be paid as per the insurance company's policy. Some of the advantages of money back policy are: it helps in saving tax, it provides guaranteed returns, money which is given at a regular intervals may be used to pay the premium or some other investment. Some of money back policy insurance products are like back policy 20 years and 25 years, Jeevan Surabhi, Bima Bachat, and Jeevan Bharati I. Next, we have a most popular kind of insurance product that is called as Ulip, unit linked insurance plans. A unit linked insurance plan offers a life insurance cover while the premium is invested in equity or debt product or a combination thereof. So types of Ulip are pension plans, children plans, group linked plans, and capital guaranteed plans. So one important advantage, students, of Ulip is like insurance cover plus savings. That means you are getting returns on your savings also, since they invest a part of the amount even in equity market also. Then last type of life insurance products are annuities. An annuity is an arrangement of regular payment of an agreed amount of money by the annuity provider to the annuity buyer in exchange of the lump sum payment of agreed amount of money in advance by the later. Such payments may be for a particular period or for the lifetime of the annuitant, depending upon the provision of the annuity contract. Advantages are like, due to the impact of compounding, the growth is fast and considerable. Tax deferment is an additional benefit. Now we'll understand the classification of annuities: immediate annuity, deferred annuity, guaranteed annuity. Annuity products, some of the following schemes which are covered under annuity products are like Jeevan Akshay 6, Forever Life, Jeevan Nidhi. Thank you so much, students, for watching this video. My humble request to all of you is kindly revise the concepts so that it remains strong forever with you. Thank you so much once again.